Let's be honest, most of us were taught RSI the wrong way, and that's why it never really seems to work. The problem is that there's so much misinformation being thrown around online, it makes it hard to know what works and what doesn't. Over and over again, I see new traders saying, "Oh, RSI is overbought. That must mean I should sell." This kind of advice is wrecking people's trades, and it's everywhere. So what's the real way to use RSI? Stick with me here. I'm about to show you the best ways to use RSI to get real profits out of the market. The most common mistake that people make is using overbought and oversold to signal reversal. This is a bad way to trade RSI. Most people assume that once RSI hits 70, it's a sell signal because the market is overbought. The same is true in the other direction. When RSI drops below 30, people think it's time to buy because the market is oversold. But this is misleading. In a strong trending market, RSI can remain overbought for a long time. If you simply sold every time RSI hit overbought, you would miss every single run and you'd end up just locking in losses. Relying on these levels to predict reversals will set you up for failure. So let me show you how to use these better. The nature of RSI, or relative strength index, is that it's a momentum indicator. Because of its oscillating nature, the 50 level is actually much more important than the 70 or 30 level. If you pull up your RSI, you'll find the 50 level right in the middle. And this level is actually the key to effectively using RSI in your trading. So think of the 50 line as a momentum pivot. When it breaks above the 50, the market is gaining bullish momentum. And when RSI breaks below 50, the market is beginning to build bearish momentum. So pay attention. When RSI is moving through the 50 line, you are seeing, in real time, a shift in the strength of the trend. This works almost like support and resistances, but for momentum. If you'd like, you could even box off the 50 zone on your indicator to help you filter out fake breakouts. Retests around this area can be excellent spots to enter in the direction of the trend. Another way to use RSI that you might be more familiar with, because we've done videos on it on this channel, is to use RSI to spot divergences. If price is making a higher high, but RSI fails to do so, making just a lower high, that is evidence of a bearish divergence. This is a warning sign that momentum to the upside is fading. The opposite is true. When price makes lower lows, but RSI fails to do so, this could be a bullish divergence. In my opinion, this is one of the best ways to use RSI. And when it's combined with other tools, it becomes even stronger. These signals are strongest when they occur in extreme RSI zones, above 70 or below 30. That's when these levels actually matter the most in your trading. Here's something that you might have never even considered before. If you open up your RSI settings, you'll see something called RSI length. By default, it's set to 14. This means that the RSI, or relative strength, is only looking back 14 candles, meaning you should only consider divergences valid where the highs and lows on the chart are 14 or fewer candles apart. If a divergence spans more bars than that, it's not as reliable. Alternatively, you could increase the RSI length if you want to account for some broader trends. The key here is to understand how changing this input changes what the indicator is telling you. These settings, like most things in trading, really should be customized to your preference. There is no one perfect answer. So, for example, you could even increase the RSI line thickness. You could change the color, I always do, to something more neutral, like white. If you use RSI just to spot divergences, you could even disable everything else on the indicator except for the RSI line itself. This removes a lot of noise and static when looking at what the indicator is telling you. So I know what you're thinking. Tom, this is some really great info, but how do I use this to actually enter a trade setup? Let's take a look at this uptrending market. You can identify this because we have a series of higher highs and higher lows. Eventually, momentum begins to fade and the price starts to consolidate. This is where a trade opportunity may begin to form. Additionally, we have a set of relative equal highs over here. These represent a liquidity target, as the market often moves to such areas to trigger stops and fill orders of market makers and whales. We're anticipating that the market will push higher to grab that liquidity at some point. But before that happens, however, we may see price dip lower. There's a swing low that the market could sweep to gather liquidity before reversing. So our first step, as always in trading, is going to be patience. We wait for price to come to us, to move down, which in this example it eventually does. But we don't just buy blindly because of a liquidity sweep. We always need confluence. You can find this using anything, but let's use the Fib tool for this example. Here we see that price has reached the golden Fibonacci retracement level, the 618, a commonly watched area for reversals. This adds confluence to our trade hypothesis. In addition, there's a horizontal support level that lines up right here in the zone. So let's go back to our RSI. Here we see that price and RSI aren't perfectly mirrored, so we know there's divergence. Price has made a lower low, but RSI hasn't. It's actually made a higher low. This divergence signals potential weakness in the bearish move and suggests that we may see a reversal. Once bullish candlestick structures begin to form, we've confirmed our divergence. We can look to enter a long position, hypothetically placing a stop loss below a local swing low and targeting the liquidity at the relative equal highs above. If you found value in this video, I ask that you share it with another trader that might gain value too. As always, make sure to smash the like, the subscribe, and we hope you come back for our next video.